Hi folks, and welcome to our weekly risk events video for the week beginning Monday, January the 11th, 2016. And before we get into the calendar here, I think it's going to be very interesting to see how the markets respond to what happened last week. Remember, last week investors were much more focused on China, the falling equity market, and the currency for that matter. And that was the dominating trade factor last week. So it's going to be very interesting to see how the risk tone is for this week to come in. And so far we're seeing Asian equities in the red. We're seeing the Hang Seng right now down over 2%. The Shanghai Composite is down over 3%. So right now it doesn't appear that we're going to see any relief right now as far as that risk tone is concerned. So we could be looking at the potential for coming into a risk-averse market. So we're going to have to see how the European markets respond to this as well. But right now, looking at Asia, we are seeing those equities markets again in the red. Okay, so looking here at Monday, January 11th, nothing really here that's going to be a major factor in the market. So we're going to go ahead and go right into Tuesday. So the first major piece of data we see here is from the UK, is the manufacturing production. We also get the industrial production at the same time. Manufacturing production is the preferred indicator here, as industrial production accounts for less than 16% of the UK economy. And the manufacturing production isn't normally a big market mover. However, if there's a large deviation, that could obviously move the British pound. We saw a contraction 0.4% in the last print. This was expected to improve a bit to 0.1%. We believe the bias is to the downside at this point with the British pound, just because the fact that the Bank of England has had to continually, they're fighting low inflation. We're already seeing some concerns over what we're seeing globally right now as far as potentially putting more pressure on inflation. So right now the bias is to the downside as the Bank of England continues to push back their plan for monetary policy normalization. Before we were looking at the beginning of 2016, that expectation has now been pushed all the way towards the end of 2016, potentially the beginning of 2017. So that's going to keep some pressure on the pound as the market reprices the value of the British pound based on those factors. So the bigger risk is for a miss to the downside to put some pressure on the British pound. Later on in the day, we'll also hear from the Bank of Japan, Governor Kuroda, and the Bank of England, Governor Carney. Both of them are speaking at the Farewell Symposium for Christian New Year in Paris. Really, the market reaction depends specifically on what is said by either of these central bankers. And that brings us to Wednesday, the 13th. We'll get the trade balance figures out of China. And we will pay attention to these. Normally, trade balance doesn't have a large effect, but the Chinese trade balance does tend to have a more significant reaction or create a more significant reaction in the market. And especially since we're seeing so much concern over China at this point, these numbers do have potential. Obviously, the bigger risk here is to the downside if the trade balance if that deficit widens and more than expected. That could not only put some pressure on the Australian dollar, it could also, as we've seen here recently, put some pressure on the Asian equities market and increase that current risk-off tone that we've seen. So we could see that really pressure the equities market. Also pressure the Aussie. It can pressure the higher yielding currencies, the Aussie and the Kiwi, and it can give a boost to some safe haven currencies, specifically the yen. We have seen the euro taking on some safe haven properties as well. Then crude oil inventories. We don't normally consider this a high impact event, but since we're seeing such a large rout in the oil market at this point, this is listed as a high impact event, so pay attention to it. Obviously, if this number comes out with a large deviation, it has the opportunity to affect the oil market, which can affect the dollar, and it can especially affect the Canadian dollar. Right now, the WTI market has found some support down near the 2009 lows. However, we're not seeing a very big bounce. We're just seeing The oil market, WTI, just basically flat at those levels, trading a bit sideways. So a solid break of those levels could see the oil market continue to fall pretty rapidly. So we'll be watching the current level very closely. That brings us to Thursday, where we will get the employment change and the unemployment rate from Australia. These numbers came out just stellar last month at 71.4 thousand. Expected to take a step back here, decline of 11,000. Forecasting the unemployment rate to tick higher to 5.9% from the current 5.8%. Obviously, these numbers could have a short-term effect on the Australian dollar, maybe for the session or so with any kind of large deviation. But right now, the Aussie's really been more affected by what's happening globally. All right, we've had some really good economic numbers coming out of Australia here. So even if we saw a miss on this, I don't think it would be overly negative from an economic point of view. But the problem right now we're dealing with the Aussie again is what's happening in China, what's happening with the global equities market, and as long as we continue to see declines or poor data out of China, declines in the global equities market, we'll probably continue to see pressure on the Australian dollar. Once that subsides, we're more neutral, the Aussie, right now, as the RBA is looking to remain on hold, and the economic data has been pretty good. But until we see improvement in China, improvement in equities, and improvement in the commodities market as well, base metals and such, even the oil market, we'll have to have a more bearish slant on the Australian dollar. Then we'll get the rate statement from the Bank of England. Rates expected to stay the same. Not much of a chance there of any change in the rates. So the market's going to turn to the monetary policy summary. That will be very important. And obviously also the official bank rates. They're expected to stay the same. If those change at all, that would have an impact on the pound, especially if this came in unanimous to remain on hold. If this went to 0.009, that would be bearish for the British pound. We'd probably see the pound continue to decline. Or if it went the other way and there was any votes added to begin monetary policy normalization, then obviously that would benefit the British pound. Otherwise, the market's going to look to the summary and the tone of the summary, whether it's a more hawkish tone, a more dovish tone. Look to see how the Bank of England is viewing the current inflation situation, how they're looking at the global situation and global risks and things like that. Unemployment claims out of the U.S., that's a weekly number, not something we're going to expect to be a real market mover. Unemployment claims have been a real bright spot in the labor market, even before we saw the employment numbers starting to come up. The unemployment claims have been near historical lows for quite some time now. So again, it's a weekly number, not something that we look to be very significant to price action. Then on Friday, we'll get the retail sales numbers out of the U.S. Retail sales basically ended the year kind of average 0.2%. Expected to see a step back here into contraction at 0.1% to the downside. Core looking to be a little bit more solid, looking for a moderate gain here of 0.2%. And that's for December's, excluding auto and excluding gas. And it's basically going to be the core readings here that are going to determine the health or weakness of the holiday sales and what they contributed to growth in the fourth quarter. Headline PPI expected to slip 0.2% for for December. We did see a stronger than expected rise of 0.3% in November. And finally, we'll finish things off with the preliminary University of Michigan consumer sentiment out of the U.S. Consumer sentiment is expected to come in at 92.7 for the January flash. which would be 1/10 higher than we saw in December at 92.6, but a bit lower than the month-end trend. The strength in this report has been centered in the current conditions component, which will really be watched closely in this report given what's happening right now in China. And inflation expectations have been very subdued. So that does it for the week. Not a very heavy economic calendar for the week. Again, a lot of the focus is going to be on other areas of the market, a lot of intermarket details, the risk tone of the market, what's happening in China, what's happening in the equities market, so what's happening in the commodities market. So that's really where our focus is going to be here, at least to begin the week. We can see if that tone starts to shift as we move through the trading week here. Okay, folks, thanks for watching, and we'll see you again for next week's Risk Events video. Happy trading, take care, and goodbye for now.